Hello, good morning everyone. Good morning. Yes. So, corporate accounting is a wonderful subject. I wonder when I start to learn the corporate accounting. So, we have three branches of accounting, everyone of us knows: financial accounting, cost accounting, and management accounting. So, we used to study financial accounting in one semester, cost accounting in another semester, and management accounting as a separate subject. Even, of course, the financial accounting will continue for 4 to 5 semesters in different forms. But why do we need to study corporate accounting separately? Do we study sole trader accounting in one semester? Do we study partnership accounting in one semester? Do we study any other form of accounting like cooperative society, trust accounting? Do we study those things in one semester? No. But we study corporate accounting in 2 semesters, corporate accounting 1 and corporate accounting 2. Why it is so? Why do we need to study the corporate accounting? What made us to it makes us to study why it is. So I request you all to post in chat box the answer for my question. Why do we need to study corporate accounting in one semester as a separate course or a separate subject? Everyone has something in your mind. I request you all to post in chat box. I will be reading the chat box. Post in the comment. So we have a comment section. You post your answer in the comment. Why do we need to study corporate accounting? Is that because of the syllabus alone? Or it has some characteristics to study corporate accounting as a separate subject? What do you mean by that? Yes. Corporate refers to company. A company who raises funds from public or from outsiders. Even if it is a private limited company, they used to raise funds from the private people. Some people. So we are responsible to the many owners. So if you take sole proprietor, we have only one owner. But if you take a partnership firm, we have only few partners as owner. But which may not be registered firm, but company is a registered firm where the owners are many. We are responsible to them, we are accountable to them. So all the transactions in company with respect to formation of company, any alteration in company or merger, acquisition, amalgamation, etc., any changes, raising funds, distribution of profit, etc., etc. So a number of things we need to be accountable and responsible towards the owners who are the public. That's why we need to study corporate accounting as a separate subject. And many things we need to know. And we need to follow as per the order and act. So that's why we need to start. What is the word company? So it is a combination of 2 words called com and penny, which means bread. Com means with, together. Penny means bread. It means, originally we used to say this as an association of persons. It denotes a group of persons and the effect of registration under the Companies Act. It's a body of individuals which has the characteristics of perpetual succession and a common seal. A man may come and go, but a company institution always exists. So it is a voluntary and autonomous association of certain persons with capital. Please underline the word. With capital, which are divided into numerous transferable shares formed to carry out a particular purpose in common. Hence, it is called as an artificial person created by law to achieve the object for which it has been formed. So a company, what is a company? A company is formed and registered under this act or an existing company. So we have Amendment Act 2013. As I said, members may come and go, but the company would go on forever. It always exists, going concern. The company is a legal entity, quite distinct and separate from the persons who are its members. A company cannot ordinarily buy its own shares. A shareholder is not the agent of the company, they are the owner. The ownership is diverse from management because a joint stock company is managed by the board of directors who are elected by the shareholders. Popularly we call them as owners. What are the characteristics of a company? Why do we need to have corporate accounting as a separate course in 2 different semesters? The reason is the characteristics of a company. It is a distinct legal person existing independent of its members. The liability of the members is limited to the extent of the face value of the shares held by the company. It has a perpetual succession, which means the members of the company may keep on changing. One time the member may sell their share or a portion of the shares, and the other who are bought, they become as a member. So that's why it's called as perpetual succession. This does not affect the company's continuity. The shares of a company are freely transferable except in case of a private limited company. So we all know that we have 2 types of companies. One is public limited, the other one is private limited. So public limited companies, the shares of the companies can be freely transferable. A company being a legal person is capable of owning, enjoying and disposing of the property in its own name. The company is a legally authenticated person to buy a security shares, to buy land, building, assets and the transfer the same. A company being a separate body can sue and be sued on its own name, can file a case against the company, or a company can file a case against the other person. Though a company is an artificial person, yet it acts through human beings who are called as directors of the company. Board of directors who are elected by the shareholders. And there is a diverse between ownership and the management. Last but not least, it is a voluntary association of persons usually for profit. So there are some companies which runs not for profit. So those companies we call under section 25 companies, not for a profit company. Like microfinance institutions. What are the different types of companies? We have private company, public company, are the 2 major types. Apart from that, we have 1% company. Please go through the materials. It's most useful. What are the types of companies based on liability? Company limited by shares, company limited by guarantee, and unlimited company. Here the liability of the members is not limited. In case of any debt rise, the liability of the members does not limit to their part of the company. Rather, it extends to their personal assets also. So that's why we call a public company as public limited company, private limited company. The percentage of ownership is based on the amount guaranteed by them through their face value. So there are many other types of companies, foreign company, Section 8 company, which means a company registered under Section 8. So it is registered for charitable purpose, not for profit organization. And Section 25 company is also like this. And the producer company is basically registered to deal with the primary production of its active members. So producer company is registered with 10 or more members being producers. manufacturers. So there are small company, subsidiary company, holding company, etc. etc. So as a company, we need to maintain many books and records as their statutory registers, books, documents, minutes. Let me have a quick break, and I request you all to go through the important part of MCQ questions. So which is going to be a major element for your assessment. We will discuss that one by one. Please pay attention, take a note in your notebook. So once upon a time, once in a while, I used to tell you to upload your notebook after scanning as a part of assignment. So please have a notebook and write whatever you understand through the online classes and virtual mode of learning. Whatever you understand, make a note to show to express your updating the subject. Now let us go through the MCQ questions, which are most important for our assessment. So question number 1. According to Companies Act 2000, a company limited by share can issue dash kind of shares. So all of us must be knowing two kinds of shares. One is equity shares, the other one is preference shares. So we have two kinds of shares. All the companies registered in the Act 2000 and the Amendment Act 2013, we have two kinds of shares. One is equity share, the other one is a preference share. Next, the public issue must be kept open at least for how many days? So we have 4 options: 10 days, 3 days, 5 days, and 7 days. So any public issue must be kept open for at least 3 days. Very good. Most of you have thought this, right? 3 days. 3 days is the excellent answer. Good. Question number 3. A minimum amount to be collected by a company as application money according to SEBI guidelines, Stock Exchange Book of India. According to these guidelines, the minimum amount to be collected by a company, what percentage it should be of the issue price. For example, if the issue price is 100, so what percentage as a minimum amount they have to collect? Can you guess and post in the comment box? So you can post your answer. Can you guess what would be? Because if you guess and then if you get to know the answer, then you will never ever forget. That's the purpose of my experience, my questioning. Please answer in the comment in this YouTube. What would be the minimum amount to be collected by a company as application money according to SEBI? 10%, 25%, 30%, 5%, what it would be? Yes, most of you are guessing well. Excellent. I could see your comment. Excellent. Yeah, very good. The answer is 25%. That means 1/4 of the issue price should be collected as a minimum amount. So we used to have subscription money, first call money, second call money, application money. So altogether it forms the issue price of the share. So the SEBI guideline says minimum 25% should be collected of the issue price should be collected. Oh, most of you have made a right attempt. If not, please make a note. During your assessment, you need to answer on time. You should get a maximum mark, good mark. Question number 4. When more number of applications are received than that are offered to the public, it is called as dash. When more number of applications are issued by a company. For example, if a company would like to issue 10,000 shares, but they got 15,000 applications from public. What do you call this? So that's what the question says. When more number of applications are received than that are offered to the public. Well, if you have a plan to issue 10,000 shares application, but you received 15,000 applications, what do you call this? Is that full subscription? Or is that over subscription? Or is that under subscription, or none of the above? If the company have a plan to issue 10,000 shares, 10,000 applications, then you got exactly 10,000 applications, then it is called over subscription. If your company is about to issue 10,000 applications, but the company received 8,000 applications from the public, then it is called under subscription. And you must be able to say the answer now for this question. When more number of applications are received from the public, then it is called as, yeah, very good. You are able to post in the comment. Please post. Yeah, your answer. Good. The answer is over subscription. Excellent. Excellent. You have made an excellent attempt. Good. Question number 5. The maximum calls that a company can make is, how many calls a company can make it? So we all must have studied in +1, +2. First call, second call, third call, final call. So as a company, what would be the maximum calls can make? The options are 1, 2, 3 and 4. So which one would be the right answer? Post in the comment. Even as a guess you may post so that you can learn. Excellent. Very good. Rajesh, Krishna, Shalini, very good. You could see your results, comments. Excellent. Yeah, the answer now is 3. A company can issue and collect money by 3 calls. First call money, second call money and final call money. Question number 6. According to table A, interest charged on calls in arrears. So what is calls in arrears? First of all, we need to know what is calls in arrears. The first call money is 5 rupees per share. But you did not receive from all the shareholders. For example, you have 10,000 shareholders. So you are about to receive 5 rupees as first call money. So 50,000 you are about to receive. But you received only 30,000. Then the balance is called as calls in arrears. The shareholders have to pay interest on those calls in arrears. That's what the table A says in Articles of Association. Table A says the calls in arrears interest have to be charged on the shareholders. If they pay late, then till the date the interest have to be charged. Yes. How much percentage it would be? The answer is, can you say the answer? I will tell you the options. 4%, 5%, 6% and 10%. So now I request you all to think about and what would be the percentage for interest on calls in advance, calls in arrears. So we have 2 subsequent questions. One is calls in advance, the other one is calls in arrears. So calls in arrears, which one the rate would be high and which one would be low? Can you see, or both will have the same interest? If you pay the call money in advance, then the shareholders have to be paying interest. Either the company should not accept calls in advance, or if they are accepting, they need to pay interest. What would be the same options are there? Now you need to choose. Now can you say calls in arrears, what would be the interest? It would be lesser than calls in advance or more than calls in advance? Simple logic. If you know only one interest rate, interest charged on calls in arrears, that's enough. You can say the other things. What is that? So the logic here is calls in arrears, you need to pay interest less than interest charged on calls in advance. Because calls in advance you are paying, calls in arrears you are about to receive. So about to receive, the interest rate should be less, whereas about to pay, the interest should be more. Because calls in advance is almost not going to be. So now, according to table A, interest charged on calls in arrears is 5%. Most of you predicted, I hope so. And interest charged on calls in advance is 6%. Now question number 8. A company can issue shares. So can they issue shares at par only, or at premium, or at par or at premium, at par, at premium and at discount? What would be? So what is at par? At par means same face value. 10 rupees face value, let me issue the shares at 10 rupees. If the share value is 15 rupees but the face value is 10, then it is called at premium. If your issue price is 9 but the face value is 10, then it is called issue at discount. So difference between the face value and issue price, face value and issue price. If the face value is equal to issue price, then it is called at par. When the face value is more than the issue price, then it is called at premium. Sorry, more than the issue price. When the face value is more than the issue price, then it is called at discount. When the face value is less than the issue price, which means issue price is more, then it is called at premium. So now the question is, a company can issue shares. Yes, in all the three options they can issue. At par they can issue, or at premium they can issue, at discount also they can issue. A company which is not so popular and they are going to have a small startup, small ideas going to be tested and going to start a company. So during that time the public will not come forward to invest on the share, so the company may issue at discount. If it is a reputed company, they would like to issue shares. If it is a reputed product or brand, then the public will come forward to invest. So that time the company would like to issue their shares at premium, so that they can use the premium for different purposes. They can generate some revenue, capital, income. Normally any company which is not reputed or which is not a new one, they issue at face value, equal to the face value. Now the answer is, a company can issue at par, at premium and at discount, all the three ways. A company can issue the shares. Now next, when the company issues shares at a price more than the face value, just now we discussed, then it is called premium. Simple question. More than the premium, more than the face value, issue price is more than the face value, then it is issued at premium. Question number 10. Normally companies can issue shares at dash percentage of discount. Normally companies can issue shares at 10% of discount. Excellent. Because you have a practice of solving some in +1, +2, some at least few questions and answers. CBSE students used to study issue of shares. So issue at discount, normally companies used to issue at discount at 10%. Question number 11. When shares are forfeited, the share capital of a company will, what happens? What do you mean by forfeited? Forfeited means cancellation of shares. Forfeited means cancellation of shares. So what happens if it is forfeited? What happens? Yes, when you forfeit the share capital will come down, reduces. Simple logic. If you cancel some shares, some capital, your capital increases or decreases. So simple logic. So the capital decreases. Is that not? Yes. So reduce is the answer. The last and final question. Securities premium will appear in the dash side of the balance sheet. Securities premium is nothing but share premium. Share premium value. Yes, the share premium will appear in the liability side of the balance sheet. Under current liability. Under current liability. It won't come in assets. It won't come assets and liabilities. Nowhere possible. Debit and credit, it does not come because balance sheet will not have debit and credit. So the answer is liability. The securities premium or share premium account comes under liability. I hope you all understood and taken notes. I request you to prepare well for the assessment which is going to be held in the upcoming week. I hope all my students will get at least 10 points out of 12. At least 10. Definitely whoever is making an attempt to watch the entire lecture, you must be able to get it. So have a good day. Thank you so much. I will get back to you by seeing all your comments which you post while watching this lecture. So as soon as you comment, I used to watch all those things and I try to reply as soon as possible. Any clarification you may please contact to comment. Thank you. This is from your faculty, Dr. Shiva Prakash, School of Management, Shastra University, Tanjavur. Thank you.